Hello, welcome back to the channel. So in today's video, I'll be covering some high quality compounding machine stocks that have been falling, as well as some of the other stocks that I'm interested in. So for reference, this is my entire portfolio. I update this weekly, but for today's video, I'll be covering stocks that are outside of this entire portfolio. So the first stock that I'll be covering is Intuitive Surgical. This stock is down around 17% year to date. It is currently trading at a 60 times of earnings. So for Intuitive Surgical, this is their business model. They sell these machines here, your Da Vinci robotics machine for surgery. So for Intuitive Surgical, they have a few different business lines. They have the machines portion, which is when they sell the machines. They have the services line where they provide maintenance for these machines. And they have the education portion as well, where they teach the doctors how exactly to operate the machines. So this business is an extremely high quality one. And besides that, the company also has a lot more runways of growth. So currently now the company is operating mainly in the US. So for example, in Singapore, we only have one machine here, which is in Mount E. So if they're able to expand globally, if they're able to displace all the old machines that all these hospitals are using, then this could be a lot more runway of growth for a company like Intuitive Surgical. So for Intuitive Surgical, here are some of the moats for the company. So first of all is that it has extremely high switching cost. So your doctors, they are trained on this machine. They spend 10, 20 years operating on these machines, and forcing them to switch out of these machines is almost impossible. They'll have to learn a whole new language, which is hard for them as well. So this is the high switching cost portion for the company. Besides that, the company has scale. It is the largest robotic surgery company in the entire world. And lastly, the company has strong recurring revenues coming into the business every single year. So as we mentioned earlier, they have the services portion as well as the education portion. Services portion is growing with their growing installed base. So as they sell more machines, they will have more machines to maintain, which will lead to more recurring revenue coming into the business. And besides that, the education front is also a recurring one that will keep coming because they can't find anyone else to teach the people how to operate on these machines. So for Intuitive Surgical, it is similar to ASML, it is similar to Otis. All these companies here, they have an installed base that is growing, which is why these businesses are great overall. But for Intuitive Surgical, here's the problem with the company, not the company itself, but the valuation of the stock price. So the stock right now is trading at a 60 times of earnings. It is still elevated relative to its peers. So for example, Johnson & Johnson is trading at around a 20 times of earnings, whereas this company here is trading at a 60 times of earnings. So for Intuitive Surgical, I think the company is high quality, but the premium that you have to pay today is probably one that is too hefty. So it is still an avoid, although it is a high quality compounding machine that is worth looking out for. Next stock that I'll be covering is Visa. So Visa is a stock that I own. I've been adding to this company. It is currently around fair value. So the stock is currently up around 10% year to date, currently trading at a 33 times of earnings. So for Visa, it is one of the highest quality companies in the entire world. So the Fed just cut interest rates, and if we're able to see lower interest rates for a longer period of time, that will boost spending. And when spending increases, inflation generally will increase as well. So this will help to boost Visa's earnings even further. So if you have to look at Visa's valuation today, the company is currently trading at a mean PE over the past 10 years. So I would say the company is now around fair value. It is not extremely expensive. It is a high quality one that is worth paying a premium for. So for Visa, the stock has been falling because of two different things. So the first one is your international remittance tax. So in your big beautiful bill, there is actually this portion here, which is your remittance tax. What this means is that when people that is not a US citizen send money out of US or send money into the US, they have to pay this 3.5% tax, which could drive down remittance in the US itself. So this is a portion that is pushing down on the stock price. And besides that, we have stable coins as well. So for the stablecoins portion, there's this narrative that your stablecoins will displace your traditional rails, but for Visa, they are currently actively pursuing this portion as well, and it has the largest network to be the biggest beneficiary of this entire stablecoins fiasco. Besides that, people took years to switch from cash to cashless payments, so it will take years for them to switch from cashless payments to more of your stablecoins portion, and I think people are overstating the risk for this crypto portion. So for Visa today, it is a decent company trading at a fair price. So I've been adding to this company over the past few months, and this company is one that is worth looking out for. Next company is one that is less well known. It is your London Stock Exchange. So this stock is now around 25% year to date. And for London Stock Exchange, they have a few main business models under them. So they have the data portion where they sell your Refinitiv terminal, similar to Bloomberg terminal, similar to FactSet as well. So for that business line, they currently have around 40% of the revenues coming in. Besides that, they have the indices portion, which is your Russell 2000, and they sell other credit products as well, similar to MSCI. So for this company, they recently just acquired Refinitiv, and Refinitiv is actually your second largest terminal in the entire world, behind Bloomberg. So for a lot of your hedge funds, they normally subscribe to Bloomberg plus Refinitiv or Bloomberg plus FactSet. So Bloomberg is still the undisputed winner, but for Refinitiv, it is commanding a decent share in this entire portion as well. So for London Stock Exchange, it is a very similar business to S&P Global. They have their indexes portion, they have their data portion. So London Stock Exchange has Refinitiv, S&P Global has Capital IQ. And for this company, it is a decent tollgate business, similar to S&P Global, similar to MSCI. And overall, this is a high quality business to own. But of course, the company now is still trading at a decently high valuation relative to its peers. Currently now, the company is over-levered, so they recently just raised a lot of debt to buy Refinitiv, and that is pushing down their earnings because they have to pay more in terms of interest expenses. So for this company today, I think it is a decent quality one. But of course, if it falls a lot further, then this could look a lot more interesting for this company. Next company is a Singaporean one. It is UOB. So the entire Singapore stock market is up around 12% this year, and UOB is lagging behind the entire stock market. So it is down around 4% year to date, currently trading at a 5% dividend yield. So for this company, the Q2 results were decent. The first half results were decent as well. So net interest income was flat, net fees increased by around 11%, and their total income increased by around 2%. So their net interest income makes up around 70% of the entire business line. And this is a portion that is currently facing headwinds from the Fed because your Fed is lowering interest rates. So here are some napkin numbers for this company. The Fed in the US is projecting 3% long-term rate. So 3% long-term rate with the current rate at around 4.25%. There is around 125 basis points to go in terms of rate cuts. So based on the company's projections, they are projecting around 1.2 basis point per 25 basis point cut in the Fed interest rates. So that will mean a 6 basis point decrease in terms of the net interest margin. So that will mean around a 3% decrease in terms of the net interest income. And I think most of this is already priced in. The stock is down 4% year to date. And for UOB, the company is currently trading at a decent valuation. So if you're to use a dividend discount model using your Gordon Growth model, the company now is pricing in a 4.7% increase in dividends over the next few years. Historically, it has grown its dividends at around 8%. So the company now is providing a decent opportunity if you're looking from a dividend discount model perspective. From a price to book perspective, the company is trading at around fair value. It is currently trading at a 1.15 times price to book, which is a discount relative to its peers like DBS and OCBC. So this company is a decent one that could look interesting in the coming months if these stocks continually fall because of your interest rate cuts. Next portion, I'll be covering some Chinese stocks. So your Chinese and your Hong Kong stocks have gone parabolic over the past few months, and the Hang Seng Index, for example, is up around 36% year to date after a 20% increase last year. So for your Hang Seng Index, the valuations now are quite high as well. So historically, the mean is at around an 18 times of earnings, and currently now the Hang Seng Index is ballooned to around a 20 times of earnings. So the valuation isn't cheap as well, and parabolic moves like this are normally unhealthy. So for Chinese equities, I would like to have exposure to it, but I would much prefer a more stable increase in terms of stock price as compared to the parabolic one that we're seeing today. So you're seeing companies like Baidu up around 30% in the past week. We're seeing Alibaba up around 50% since its earnings report. So overall, I think all these different companies, they were cheap before the bull rally started last year. But of course, at its current state, I would much prefer to wait for a pullback before I start looking for allocations into these companies. Baidu is a company that is trading on pure momentum. I've said previously as well that the company is losing its moat. The company is losing market share in terms of your search portion, and the AI portion is only a very small portion of the entire business. So for Baidu as well as some of your other Chinese equities, they are up purely because of momentum, and I would wait for a pullback before I start adding to all these different Chinese companies again. Last portion, I'll be covering some questions left in the comments. The first one, it says, how much will you buy Otus? So Otus is a decent company. The stock is trading at $90 per share. I think the company is trading at around fair value today. For Otus, it is a decent quality company. It's similar to ASML. It is similar to Intuitive Surgical. The company is currently facing headwinds because of the Chinese housing market, and once that portion starts to recover, then we could see a lot more growth for Otis as well. So for this company, I'm still researching it, and I will look to have a starter position in this one at its current price. I think price today is around fair for starter position. I've been saying in previous videos as well that this company is a high quality one. I hope you guys have found this one useful and invest